Hello, this is Domenico with Easynomics, and today we're going to look at the real-world example of an ad valorem tax applied to gasoline. And in the second video that will follow this one, we'll look at a per-liter subsidy to that gasoline in Spain to alleviate the inflationary pressure caused by the Russian-Ukrainian war and the spike in gasoline prices. This video is part of a few playlists within the channel, but it's definitely featured in the real world playlist where I have a variety of real world examples that you may need for paper 1 part B section. It also provides good practice for paper 2 and also may provide you with insight in how to dissect an article for an internal assessment. So here you can see I have a running series on the Russian-Ukrainian war where we're looking at petroleum, its price elasticity of demand, its price elasticity of supply, shifts in the supply curve and demand curve, OPEC as a collusive oligopoly or monopoly, applications of perfect competition, and now we're going to look at the ad valorem tax applied to gasoline. So the article that I've used on a paper 2 exam that I wrote for my students was using this article, looking at a 20-cent discount per liter of fuel, which is a subsidy for gasoline. And this will be the main focus of the second video after this one. But just to give some context, Spain, as a result of the Russian-Ukrainian war and the spike in petroleum, energy prices, food prices, launched a $16 billion plan to help households, low-income households, middle-income households, deal with the inflationary pressure caused by rising gasoline prices. So here we have a solution of a 20-cent discount or subsidy per liter for all drivers in Spain. How much is the price reduced by and for how long? It's 20 cents per liter. It was originally intended to last until June 30th, but it went all the way to the end of December and just finished just recently. We're in January of 2023. At the end of December 2022 was the end of this help. It was applied to all types of gasoline, including natural gas, liquefied petroleum, and so forth. And then below here it says who paid for it. It was the taxpayer, right? Tax revenue being used to provide the subsidy. But we can see that the Spanish government was paying 15 cents of the 20-cent per liter subsidy, with the remaining 5 cents paid by the petroleum stations, but only by petrol stations that were generating $750 million per year or more. If not, then the Spanish government would cover the full 20 cents. So here is the right side of our whiteboard are the details from a receipt that I got when I bought gasoline in Spain over the summer. And it was G95 gasoline for my hybrid car. I bought 18.76 liters, so that's the quantity that I consumed. The price per liter was 1.799, but that includes the tax. So 18.76 multiplied by that price gives us a total cost of 33.75. But I did not pay 33.75. I actually paid 30. So the price paid by the consumer was $30. Again, this will be featured in the next video after this. What we're going to focus on is the application of an ad valorem tax, a 21% tax on gasoline. And the price before the tax was 27 euros and 89 cents. So to get a sense of what the price is per liter, let's just do a quick calculation. So here we have the value of 27 euros and 89 cents divided by this is euros. I'll just clean that up a bit. Try to make a better euro sign. 27.89 euros divided by the number of liters. I bought 18.76 liters of gasoline. And so that will give us the per unit or per liter value. And so that works out to 1.48666737. All right. And then that is the price per liter or price received by the producer with the tax. So I'm just going to make a note that this is the price received by the producer or the provider of gasoline, the gasoline station, before the tax is applied. Okay. Then if we take 1.48, we multiply that by the 21% tax, that's going to give us this value here. So below, I'll just make that calculation of 1.48666737. And of course, on an IB exam, you would provide a value up to the second decimal figure, accurate or rounded up to that figure. But I'm just going to include all of this, multiplied by a 21% tax. So here we see it's 21% ad valorum tax. So to make a simple calculation, I'll multiply it by itself with an additional 21%. That's the decimal value. And that equals 1.7987, or simply 1.799 euros per liter with the tax, which is what we see here. So this price is the price with the tax, 1.799, and then prior to that tax, it's 1.486, and so on. So I'm going to use those values of price to illustrate the price received by the producer and the price paid by the consumer in this model. So let's go ahead and draw our relatively inelastic demand curve, because there's no close substitute for gasoline for people that have a hybrid or gasoline car. So demand equals the marginal benefit to the household of the consumption of that gasoline. And since this gasoline has been refined and gone through a manufacturing process, I'll assume that the supply curve is relatively elastic, or at least more elastic than the demand curve. So here I have my supply curve. Actually, let me draw that. Let's draw it like this. Okay, so here we have our supply curve, and that's equal to S1 equals the marginal costs of production, and the intersection provides our free market equilibrium. So right here, I'll label this point A, make it a little bit bigger. Point A sets the free market equilibrium price and the free market equilibrium quantity. So I'll label that price equilibrium in the free market and the quantity equilibrium in the free market. Now, I don't know what that price is. I don't know what that quantity is. But with my receipt here, I have an idea of what the price received by the producer with the taxes and the price paid by the consumer. So the Spanish government applies a tax, an ad valorum tax. So that has the effect of shifting the supply curve inward by the value of the tax. And because it's an ad valorum tax, the the supply curve is going to become steeper and steeper and steeper as the marginal cost increases, because I'm taking a percent of a value. So let's say 10% of $1 is 10 cents. 10% of $100 is $10. So as the marginal cost rises, the distance between the two gets wider and wider and wider. And I'll create a separate video to explain that if that is not immediately apparent. So here we have our S2 curve equals the original S1 curve plus the applied tax. Okay? And that's going to set a new equilibrium right over here. So I'll label this point B. And here we have our price paid by the consumer. The tax has increased the price paid by the consumer. And then here we have the reduced quantity. So quantity with the tax. And the gasoline petrol stations really operating along their S1 curve. This is the marginal cost of providing gasoline. That includes their land cost, rent, labor cost, paying wages, capital cost, paying interest. It's all within that S1 curve, but it doesn't include the tax. So we add that tax and that becomes the S2. So right here, this becomes the price received by the producer. So I'm going to label this PNP, which is price received by the producer. And I'll create this point C to help us with our analysis. So I've effectively drawn this model with my inelastic demand curve, my relatively elastic supply curve, and then I can go ahead and label some areas to help me with my evaluation. So I'm going to label areas A, B, C, D, E, F, G, H, and I. Okay. Now, again, the free market price, I'm not entirely aware of, but I've bought with the tax this quantity, 18.76 liters. So essentially, here's my 18.76 liters of gasoline that I have purchased at the quantity tax. And at that quantity of Q tax, the price that I paid per liter, again, we quantified it to 1.48 or 1.49. I'll round up 1.49. So the price received by the producer is equal to 1.49. I'll just round it up, euros. And with the 21% tax applied to that, 21% applied to 1.49 gives us the price paid by the consumer, which is 1.799, let's say, which is equal to the price paid by the consumer with the tax, which we see here. So again, here's the price with the tax, 1.799. That's the price paid by the consumer. We don't see it in the receipt, but we can calculate that the price received by the producer is 1.49. So right here we have the price received by the producer with the quantity of tax. Okay? So I'm going to go ahead and analyze this model as I would for a paper exam, and then we will evaluate. In graph A, the market for gasoline in Spain, we're measuring price on the y-axis, quantity on the x-axis. We have a downward sloping demand curve labeled D1, which is equal to our marginal benefit, and it's downward sloping according to the law of demand. We're going to make a note that since gasoline has no close substitute to the household consuming that gasoline, that the PED value is inelastic, is a value less than 1. So that in theory, as price rises, total revenue increases for the producer. We have an upward sloping supply curve labeled S1 equal to our marginal cost, upward sloping according to the law of supply. And we notice that where S1 equals D1 at point A, where they intersect, that provides a free market price at PE and a free market quantity at QE. At QE, the quantity supplied equals the quantity demanded. Then we have a change. The government intervenes and they apply an ad valorem tax of 21%. So that causes the supply curve to shift upward by that value from S1 to S2, which is equal to S1 plus the ad valorem tax. That creates a new intersection at point B, where S2 equals D1, providing an increased price paid by the consumer. It increases from PE to PC, and that has the effect of reducing the quantity demanded along the demand curve from point A to point B, which is a movement along the demand curve, or a decrease in the quantity demanded from QE to Q tax. In addition, the price received by the producer decreases from PE to P and P, price received by the producer. That has the effect of reducing the quantity supplied along the supply curve from point A to point C, or from QE to Q tax. We can notice that at the quantity of Q tax, at the quantity of Q tax, the marginal benefit is greater than the marginal cost. So I can just illustrate that right here at point B. That is my marginal benefit, because that's my demand curve, and it's greater than my original supply curve marginal cost. So the marginal benefit is greater than the marginal cost, meaning that there's an under allocation of resources to the production and consumption of gasoline versus what is desired by society. But we can also make a note that gasoline is a negative externality. For the household that consumes it, it's a negative externality of consumption. The consumption of that gasoline leads to carbon emissions, which is a contributor to urban pollution and climate change. So society would actually like less. So in theory, the tax is actually reducing the quantity to what would be allocatively efficient. But that's a topic for externality discussion. So let's just assume that the free market point A is the allocatively efficient level of output. Fine. Now let's move on to evaluation. Let's evaluate the impact of this tax on different stakeholders. First, let's look at the consumers. How is consumer surplus impacted? Originally, consumer surplus was areas A plus B plus C plus D, which is this shaded area here, okay, which is what you see there, okay? Then it is reduced, the level of kind of household savings reduced as a result of the rise in price from PE to PC. So consumer surplus, as a result of the ad valorem tax, is reduced to area A. Okay. How about producer surplus? Producer surplus was originally areas G plus F plus E plus H plus I. Follow that supply curve up to the free market equilibrium price. It was originally this area. But because the price received by the producers reduced, producer surplus is reduced to areas H plus I. So producers are worse off, kind of a little bit less profit, kind of, for them. What about total revenue for the producers? It's also been reduced. Originally, producer surplus was areas PE times QE, price times quantity. So it was this total area. That's the amount of revenue collected by the gasoline stations. But as a result of the reduced price received, it's now P and P multiplied by the quantity of tax. So we have a reduced total revenue area. So again, producers are worse off. What about workers in the gasoline petrol station industry? They are worse off because since the entrepreneurs that own those gas stations are reducing the quantity supplied from point A to C or from QE to Q tax, they're going to have to fire some excess resources like labor. So they'll create some unemployment within that industry. How about the government? The government is better off because they get to collect tax revenue. Before they did not collect tax revenue, now they can. So it's the value of the tax, right? 21%. So 0.49 to 0.79, it's about a 30-cent tax in this case, multiplied by the quantity of units, about 18.76 liters. So this is the amount of tax revenue collected by the Spanish government. Now, one thing we can note if we're looking at elasticity is who carries the burden of the tax, who's carrying more of the burden, who's more negatively affected by the tax. And we can see that in this rectangular area, the consumers, areas B and C, is larger than the producer surplus loss of areas G and F. So the consumers carry a greater burden of the tax than the producers because areas B plus C is greater than areas G and F. And that's a result of the demand curve being relatively inelastic, where with an inelastic demand curve, we know that the percent change in price is going to be greater than the percent decrease in the quantity demanded. How about society as a whole? Well, again, we highlighted that at Q tax, the marginal benefits greater than the marginal cost. There's an underallocation, and that will create a welfare loss to society. That welfare loss is represented by the areas D plus E. which we will go ahead and highlight. So here we have area D, which is the lost consumption as a result of the increase in price. And we also have the lost production of area E due to the lower price received by the producer. And there we go. We have graphed the model, analyzed it, and fully evaluated it. Again, we can make note that the value of the tax, the distance from here to here, is about 30 cents. In this case, for 18.76 liters, it was 0.30 was the value of the tax here. 30 additional cents added to the price received of the producer of 0.49, going up to 596,979. Okay. If you have any questions, feel free to comment those questions below, and don't forget to subscribe and to like. Part 2 of this video will look at the per liter subsidy. We're going to put that per liter subsidy on this quantity of tax consumed and graphically illustrate what has happened. And that's it. Until that video, until next time, take care.